Hello, this is Domenico with Easynomics, and this is part 6 of a series of videos tackling a paper 3 question. In part 5, and all of these will be linked in the video notes below, we were plotting the average fixed cost curve, with fixed costs being at $12 million, and we were dividing that by any quantity of seats: 40,000, 80,000, 120,000, 160,000, and so on. In the previous videos within this series, we understood as higher level students that every downward sloping demand curve has both an elastic and inelastic portion, and how that also relates to total revenue. And we also plotted the marginal revenue curve, which is the midpoint across the demand curve, and so on. So all of that is covered in previous videos. You can check the links below to review those aspects if needed. This video, we're going to look at these questions and go back into the idea of a perfectly inelastic supply curve and what's the impact of a tax being added to a perfectly inelastic supply curve. So let's look at the question here. So figure 1 shows the demand curve D1 for and supply S1 of tickets for the 2023 UEFA Champions League final in the Atatürk Olympic Stadium in Istanbul, Republic of Türkiye. 80,000 tickets are available for the match, which is pretty much the full capacity of that stadium. The city government of Istanbul decides to impose an indirect tax. So as we read a question, I think it's a good idea as a student to kind of highlight key parts of the statement so you're focused on what the question's asking. One is the fact that we have a fixed number of seats, 80,000 tickets being supplied. So that's going to give us an understanding that the supply curve is perfectly inelastic. In addition to that, it's asking us to consider what's going to happen when an indirect tax of $100 is imposed on a perfectly inelastic supply curve. And we have $100 being applied as tax per ticket. So the first part of the question, part A, asks us to draw and label the tax revenue generated from the match on figure 1. So I want you to pause the video and think about what would that look like in this diagram. How would you draw it? What would it look like? Go ahead and pause the video and consider that, and we'll take a look at your thoughts in just a moment. Pause the video now. Okay, so let's check your work. We're going to go over part A here. Okay, so we got to understand a couple things. Number one, we have a fixed quantity of supply of tickets. So we see the supply curve S1, and it's perfectly inelastic. PES as a formula is equal to the percent change in quantity supplied divided by any change in price. And when we have a perfectly inelastic supply curve, that basically tells us that the change in quantity of supply is 0. There's going to be no change. We're not going to build more seats or destroy seats as a result of a change in price. It's fixed at 80,000. So 0 divided by any change in price is going to be 0. So we can increase price, the percent change in price. We can raise it by 10%, 100%. We can lower it by 50% and so forth. But the quantity of seats will not change. It's unresponsive. So here we have that perfectly inelastic supply curve. So it's perfectly inelastic. Perfectly vertical. In terms of tax revenue, when we think about the tax being applied and so forth, we're going to remember that the tax revenue generated is going to be that difference between the price paid by the consumer minus the price received by the producer, with the difference between them being the tax value multiplied by the quantity. Okay, so let's take a look here, and I'll choose another color. I'll go for purple. So we have an equilibrium. D1 equals S1 right here. And we have an equilibrium price set at 500. So that is equal to the equilibrium market price, which is also going to be equal to the price paid by the consumer. So here we have a price paid by consumer, in this case being $500. The price received by the producer is going to be less because they're going to have to subtract the tax, and the tax is valued at $100. So $500 minus $100 is going to be $400. So this will be the price received by the producer, with the distance between $500 and $400 being the value of the tax. So I'm going to make a little note here that the distance between these 2 points is the value of the tax. So the tax is $100. There's going to be no change in the equilibrium because the supply curve is perfectly inelastic. It's not going to shift outward or inward. And the consumer will not face any of the burden of the tax because we know that the burden of the tax, rests on the more inelastic curve. So PED, the value of PED is going to be more elastic than the value of the supply curve. So the value of PED can be greater than the value of PES. Well, the value of PES is 0. So the full burden of the tax will be on the consumer. Full tax burden will be on the producer. The full tax burden will rest on the producer because the PES value of the supply curve is less than the PED value of the demand curve. So in this case, since it's perfectly inelastic, the producer carries the full burden. This goes back and relates to another video where we had a very inelastic demand curve versus a more elastic supply curve. And when we applied the tax, shifted in from S1 to S2, and we can see that we have the tax being the value between PC minus price received by the producer, but the burden of the tax, this dark bluish area, is on the consumer, whereas the producer tax burden is much smaller because they have a more elastic supply curve. It's the same kind of idea. So we see that here, that the supply curve is perfectly inelastic, so the full burden of the tax is on the producer. So graphically, visually, since it's asking us to draw and label a tax revenue, it's going to be this. So we have the equilibrium price of $500 minus the tax of $100 being $400. $500 is the price paid by the consumer, $400 being the price received by the producer. And this area here that we'll shade in is going to be the tax revenue. That's going to be fully paid by the producer. Okay, right there. And I'm going to go ahead and label that for this question. I'll call this the tax revenue. Fine. So I've done part A. I've drawn and labeled the tax revenue generated from the match. Great. Next, part B, calculate the tax revenue earned by the city government for the match. So let's look at part B. Let's pause the video and go ahead and calculate what the value of that tax revenue is going to be, and we're going to check your work. Pause the video now. Okay, so let's take a look. So for part B, tax revenue, again, is this formula. All right, tax revenue is equal to the price paid by the consumer minus the price received by the producer multiplied by the quantity of, in this case, tickets sold. So that is equal to $500 minus $400, price received by the producer, which is simply $100, multiplied by a quantity of 80,000. So here we have $100 of tax revenue multiplied by an unchanged quantity of 80,000 And so the tax revenue is going to equal 8 million. Or I can say 8 million. $8 million of tax revenue being collected by the city of Istanbul for this match. Great, I've done part B. Done. Now let's move on to part C. Taking into consideration the average fixed cost per ticket already calculated, which is covered in a previous video, in a previous question. We have $150 is the average fixed cost per ticket, and take into consideration the tax, calculate the profit that will be made from the match. So I want you to pause the video and go ahead and calculate that. We'll check your workings. Pause the video now. All right, so let's look at part C. Part C. So in the previous question, we've calculated the average fixed cost being $150. We have a tax value of $100. So this green area here is the value of profit. Okay, how can we calculate that? Well, let's just take the price received by the producer of $400 minus the costs of $150 multiplied by the quantity, and that will give us the value of the profit. So here, let's think about, let's see if I'll make some space here. See, profit is equal to the average revenue minus the average total costs, price minus costs multiplied by the quantity. And in this case, the average revenue, or the price received by the producer per ticket after tax, is $400 minus the cost on average of $150. In a previous question, it's stated that there's no variable costs, only fixed costs. That's an assumption, multiplied by the quantity of 80,000. So that works out to 400 minus 150 is 250. So we're going to continue over here. $250 of profit per ticket multiplied by 80,000 tickets. And the profit will be 20 million in this case. $20 million of profit. So this green boxed area is reflective of the profit margin generated by the firm offering these tickets for this match. $150 going down to zero. This is the value of the costs on average per ticket. And so this brownish boxed area is the total value of all of those total costs, which is in this case only fixed costs. There are no variable costs. In addition, we have the tax revenue in the purple shaded area, which the producer does not keep. That goes to the government. We can also see that the consumer is not impacted whatsoever, that their consumer surplus is unchanged. So we've done part C. Perfect. Last question, D. Explain how the incidence of taxation on consumers and our producers will be influenced by the price elasticity of supply. Consider how you would answer that question. So you can pause that video, think of your response to that question, and we'll go over that in just a second. Okay, so what is the impact of the tax incidence when the PES is zero? Well, if the PES value is zero, it means that it's perfectly inelastic. And as discussed in this previous video, that I'll have linked below, the more inelastic the curve, the greater the tax burden. So in this case, the demand curve is more inelastic than the supply curve, in this case for cigarettes, due to its addictive quality. So the consumer carries that tax burden, which is this blue, dark blue boxed area here. In the context of this question, since the supply curve is completely inelastic, the producer will carry the full burden of the tax. So since PES is zero, it is the producer carries the full burden of the tax because the PES value is less than the PED value. But since it's zero, the entire burden of that tax will be on the producer. The consumer has an unchanged level of consumer surplus. And to illustrate that, here we can draw the consumer surplus area is this triangular area here. It has not changed at all as a result of this tax being imposed. The consumer surplus is constant. So we'll do one more video. In the next video will be quite simple. It'll be a short video. We're going to just simply go ahead and calculate this consumer surplus. What's the value of that consumer surplus? And that's it. If you have any questions, feel free to comment those questions below, and feel free to please subscribe and like. Thank you so much.